Hello, welcome to Straight Data Business. My name is Kurt and I'm a value investor. Today I'm going to show you my analysis of Tyson Foods Incorporated. It's a great stock that pays a dividend. It seems to be close to its intrinsic value, its fair value. So let me show you how I came up with that calculation and how I determined the fair value of the company. Let's look at some of their fundamental financials and let's get into it. So here's my spreadsheet for Tyson Foods Incorporated. You can see this is sort of the landing page where I have some summary information about the stock. And we'll go over this. First, I want to go through all the tabs and show just the financials of the company and some of these trends. Starting out, I want to look at the pillars of the company, and the pillars show me if the pillars are good, then it shows me how projectable, how certain I am about the future of the company. If these pillars are all over the place, if I'm getting lots of red X's, it tells me the company may be good value, but relative to its projected future discounted free cash flow, but that projection may not be very reliable. So if it's got lots of green check marks here, that means it's a sturdy company. It's uh, it's a it's a healthy company and it's a consistent company. Now, you see out of 21 sub-pillars, we have 14 here. Gets a little exclamation point. It's a little warning sign. 6 out of 8 isn't bad, but I want to specifically look at the debt sub-pillars. You can see that all 3 of these are very close to the criteria, and they all just happen to land on the wrong side of the criteria and get an X. Like 125% is the value where we're looking for long-term liabilities to be less than the last 5 years free cash flow. We're getting not less than, but 25% more than, and that's pretty close. I mean, in another world, in a slightly better balance with a slightly better balance sheet, this could be less than 100%, and this would be a green check mark. Same thing with 89%. Total assets minus intangibles minus property, plant, and equipment over divided by 2 is greater than total liabilities, almost, but 90% there, but not quite. And 25% instead of 33% of their cash on hand relative to their current liabilities. So all 3 of these could easily be green check marks. And so I'm going to give Tyson a pass on their balance sheet. This actually should be a 7th green check mark and 3 close to check marks to bring this up to 7 and 17. That would be a lot better of a score. All in all, I look at Tyson and I like the company. I like the pillars. I just want to read a little bit about Tyson Foods Incorporated, what they are. You might see Tyson's brand on frozen chicken bags in the grocery store, but you may not know that they also own Hillshire Farms meats, and they also own Ballpark Franks. So those are 2 big brands. These are big brands that are in grocery stores. People see them all the time, and they are buying them. Tyson Foods does operate in the United States, although I think they have some international operation. They are headquartered in Arkansas, Springdale, Arkansas. They have 4 business segments: chicken, beef, pork, and processed foods. So they make foods from like farm animals, and they process them and they send them out. They don't just send to grocery stores, though. They supply some notable fast food chains and other restaurant chains. So it's a pretty solid business, pretty well entrenched into this industry of food production in the United States. And so that is something that I'm looking at going, yeah, that's a pretty good moat, that's a pretty good business, and it's a great brand. So let's look at some of the financials of the company. Starting with, well, let's just look at the price history. This is the price history. It's not super consistent, does go a little bit all over the place, a little bit cyclical, but you can see they've had great uptrend. And if you can see in the light blue line is the day-to-day price, and it did drop a lot during COVID, but the moving averages are in the darker blue lines. Yes, they've recovered, but unlike a lot of tech companies, they haven't skyrocketed past their pre-COVID price, which is pretty good. There's been a lid on their price. They have recovered well from the COVID sell-off, but they're sitting at a decent place, and you can see the uptrend in the share price. Now, shares outstanding is something I want to look at. Always want to make sure that a company's not growing, meanwhile diluting me as a shareholder by issuing a lot of new shares. And Tyson, since 2016, has been slowly, very slowly, consistently, though, buying back shares. There was a small stint here where they went from like 380, 370 something, and then 360, and they sprung back up to 400 million shares in 2014, which this is a sliding scale. There may have been some sort of acquisition here or spinoff. I don't like to get too into the details of a company's past and history. I like to let the numbers tell me what's going on. And I can get over this small bump in the road because they bought back a lot of the shares, and whether it was an acquisition or something with their books, they're back on track. And in the last 5 years, they've been slowly, consistently buying back shares. It's not something that's getting me super excited as far as buybacks, but I'm just excited that they're not issuing a bunch of new shares. It's a stable business. This is their price to earnings ratio over the last 10 plus years. And you can see that they spend a lot of their time between 10 and 15 on price to earnings ratio. And so they did dip down as low as 6.7 back in 2018. And now they're somewhere around, and I can actually look this number up on my main sheet, 7.4. So when a company is trading at 7.4 price to earnings and it's a big company and they don't have any major issues, this is definitely a note to look at this company. Your ears should perk up and you should study it and say, hey, is this trading below its fair value? I mean, ideally, we would buy this and hope that it returns back to this 10 to 15 price to earnings ratio trend. And I mean, if it went to 15, then we would essentially be doubling our position. I mean, that would entail a price increase, a doubling in the price of the shares. So that is something that just returning to their trend would be good. But this is their history, and return on invested capital here is something I also look at. I love to see companies who live and consistently above 10% return on invested capital. That just shows that the company knows how to grow their business. They know how to deploy the free cash flow that's coming in to make the company better and to keep the company, perpetually generating more profits. So they were approaching 10% back before COVID, but since then they have really gone on a tear here, and they've been able to grow their returns because their profits have gone through the roof because lots of people are eating chicken and shopping at the grocery store and buying Tyson's food products. So they do live consistently, though, in that 10 to 20% range. So I like that. For a well-established company, that's actually really good. They do pay a dividend, and if I go back to the dividend the pillar page, I can see that their dividends are 29% on average of the last 5-year free cash flow and 26% of the trailing 1-year free cash flow. So what does that tell me? That's a good sign. I like to see a company pay less than 50% of their free cash flow out in dividends. 25 to 30%, that's kind of a lot, but it still leaves them 70% plus to put back into the company to pay down debt and to buy back shares. So those are all things that I like a company to keep. If they're paying out more than 50% of their free cash flow in dividends, it kind of makes me anxious because it makes me think that this company is just in the business of shelling out the money, and they don't really have a plan for redeploying the free cash flow, redeploying the capital to grow the business. And so I'm a little bit weary that, hey, this company could just be on its last ropes. It could just be kind of liquidating itself out to shareholders. And so I like to see them retain some of their free cash flow when it comes to dividends. But they do pay a healthy dividend. I think I don't have it here, but I think it's about 2.2% currently yield on their dividends they pay out. Here's their free cash flow trend, and this is a beautiful trend. I love this. You can see they go up, they come down, but overall they've been growing their free cash flow a lot over the last 10 plus years. They do have a recent drawdown in free cash flow, but I look at the historic growth somewhere in the ballpark of 10%, and that's what I put in for my free cash flow projection, with a 13 to 20 year horizon growth of 4% and a perpetual growth of 2%, because this is a great big food company. They're not going to, even 20 years from now, they're going to be selling chicken, and they might not be growing fast, but they'll at least be keeping up with the economy or close to it. Now, when I look at revenue, and I'm going to show revenue briefly, it's a pretty flat line, but it's had a nice notch up in the recent time during COVID. I look at something closer to 6% growth. If I look at the longer trend, it's maybe 5%. Shorter trend, it's 8%, but I like 6% and drawing down to 4 and 2 again. And their net income has actually really exploded over the last couple of years due to COVID. I think there's a simple explanation for this. People eating out at restaurants less and then eating at home and going to the grocery store and buying foods. And as we go into recession, I like the story of Tyson because they sell hot dogs, they sell chicken, they do sell some beef products, but I think people are going to move away from more expensive products to eating at home. They're going to eat out less, they're going to eat at home, and they're going to buy chicken rather than beef. And Tyson's really big into chicken, and people, I foresee a world with a bad recession coming that people will eat chicken and hot dogs more than beef and whatever else they eat, vegan something, I don't know. But I just really like the resilience that this company has. Whether you look at inflation or recession or stagflation, I feel like Tyson's right in the sweet spot to deal with it because they've got pricing power. People will cut Netflix, they'll cut their TV, they'll cut, they'll do a lot of things. They'll sell a lot of things before they stop buying chicken at the grocery store. And so, if we look at their balance sheet, let me zoom in here. Assets, liabilities. I have a personal thing where I don't trust a company's intangibles, their goodwill on their balance sheet. That's a really big intangibles. Now, with a company as big as Tyson, I understand that their brand actually is important. It is big. I just don't really trust companies when they put that on there because they could say their goodwill, their brand power is 20 billion, 40 billion, 100 billion. I don't know the difference. So I'm just going to exclude that. So what I usually do is I take their total assets, subtract from it their intangibles, and subtract from that half of property, plant, and equipment, because property, plant, and equipment could be heavily weighted in land, real estate, which in a big recession could drop drastically. Other assets that they own could drop drastically in a short period of time. So I like to look at the cash they have, the receivables they have shows me some of their power on their balance sheet versus their current liabilities. But all in all, if I was being most accurate, I might just divide their intangibles by 2. I subtracted the whole thing just to be extra conservative. So what I'm looking at when I'm looking at their balance sheet is pretty much leveling out because I take away 17 billion from 36 billion. I'm left with like 29 and I'm left with like 19 or 20. And then I subtract like half of 8. So I subtract 4 and I'm getting very close to their current liabilities anyway. So it all sort of balances out. They almost have a zero balance sheet when I look at them, although I probably could give them better credit. And what that means is when we get to the end of the day here, this is going to be based on their future free cash flow plus their assets minus their liabilities. And these are the charts that basically tell me their intrinsic value. And it's plotted by expected return, which really is the discount rate that we use. So if you ask me what's the fair value of Tyson chicken, whatever it is, Tyson Foods Incorporated, I'll ask you back, well, what discount rate do you want to use? What return are you happy with? If you say 10%, I'm going to point you right here to this plot right here. I'm looking at it from the perspective of the revenue, translating that to free cash flow. I'm looking at it from the angle of net income trend, translating that to free cash flow. And I'm looking at it from free cash flow itself. And so 3 different perspectives. With 10%, I get a nice boundary. And of course, I simulate this tens of thousands of times. You can see my worksheet goes okay, well, maybe not that far, but at least whatever I have here, 60,000 rows. I think 70,000 is the number of simulations I use with a standard error and a distribution. I also use a safety factor and kind of fold that into my final numbers. In this case, I used a safety factor of 1.25, which is I'm basically dividing the fair value numbers by 25, by 1.25, reducing them by 25%. And that's the lowest safety factor that I use. I can use a safety factor usually around 1.33, 1.5. If the company's I'm uncertain about how I'm projecting it, I want to be a little bit safer and use a bigger safety factor. Sometimes I use a safety factor of 1.75 or even 2 if the company is not very consistent and steady. If it's a consistent, steady company, 1.25 works. And that's what I've used for Tyson because I really like the moat and the brand they have. But I'm also buffering my expectations that little bit, that little 25% to just book that, bake that little extra conservative nature into my valuation. So all that means that I can look at this chart and you can pick out anything on here. You know, if you want 20% returns, well, maybe you should only pay between $25 and $75 for Tyson Foods. Right now, Tyson is trading at $82 per share. And here I have a little summary. I can change the desired return. Right now I have it set to 10, and it pulls in 6 values from this distribution and kind of tries to nail down a low, medium, and high estimate for Tyson. The low end is 77. The high end is $200 per share. So when I'm looking at $82, if I want a 10% return, and remember 2.2% of that is coming to me in the form of dividends, then this is a great price to buy it at. Now, here I show the distribution of valuations based on those 70,000 iterations, those 70,000 times that I simulated this. And here, this just shows me the percentile along the distribution. So with the safety factor, we're right in the middle. We're right in the middle of the distribution as far as the current price, $82 per share. It falls right somewhere here, which kind of equally balances this big tail end distribution. So, but without the safety factor, if I just want to look, you know, there is some conservative adjustments built in before this as well. But if I just look at the non-safety factor, that's a 63% chance that the company is currently underpriced compared to its fair value for a desired return of 10%. Now, if we change this to 15%, if you really want to get bigger returns, then the fair value is going to come down. You should pay less for this company. You should pay between $40 and $108, which again, the current price being 82 sits somewhere in this band. So it's above this medium estimate for fair value. So if you're looking for 15% return, Tyson may not give it to you. But if you're happy with something lower like 10 or even 8%, let me turn on 8% desired return because I think a lot of people could be happy with that for such a certain stock. And look at this. This means there this means there is an 84% chance the stock is undervalued in order to give you a desired return of 8%, or with a safety factor, even 70% chance. So this band, the price is below all of this, and so I feel very comfortable with a company like Tyson. My summary on Tyson Foods is that it's a great company. It has really good fundamentals. I mean, maybe a little couple hiccups on their balance sheet, but it has great fundamentals as a company, has a great brand, has a great moat, and it's trading at prices that are really low, and it's starting to get to that point where even at 10% desired return, it's below its fair value, and at 8% return, it's definitely below fair value. So take a look at it. I don't currently own it because I think that there's better opportunities, although I will say if I was looking to diversify, to hedge my portfolio a little bit with concern about inflation, with concern about recession, this is a stock I'm looking at closely, and I'm watching that price. If it gets low enough, I might have to buy. Well, thanks for watching this review. If you like this video and it provided you any value, please give it a thumbs up, and I'll see you on the next review. So that's it, folks. That's Tyson Foods Incorporated, and you can see it's pretty enticing. Go ahead and comment down below if you want to buy this stock, and again, give this video a thumbs up if you enjoyed it, and subscribe for more on discounted cash flow valuations and commentary on politics, markets, and economics. See ya.